Congratulations! You are now in charge of an electronics sensor manufacturing company. Unfortunately, you're taking the helm of a poorly managed corporation. The problems were masked by industry growth and weak competition. To turn the company around, you have to improve and expand your product offering while increasing productivity. Not an easy trick in a competitive environment. To pull it off, your management team takes a back-to-basics approach and concentrates on the 4 Ps: price, promotion, place, and product. Product is primarily controlled by research and development, which updates existing products and invents new ones. Customers fall into different market segments. Some customers want proven products, while others are biased towards miniaturization or high speed. Segments are named for their customers' top concern and are called traditional, low-end, high-end, performance, and size. These segments can be visualized using a perceptual map, which plots 2 design attributes: the sensor's size and its performance. Circles represent groups of customers. They cluster near the design attributes they want. These clusters are called market segments. Traditional customers want tried and true technology of moderate size and performance. Low-end customers want low prices and are willing to sacrifice miniaturization and performance. High-end customers want products that are fast-performing and small in size. They are willing to pay high prices. Performance customers want performance and are willing to sacrifice miniaturization. Size customers want small products and are willing to sacrifice performance. In each segment, customers fall within a set of circles: the fine cut and the rough cut. Customers want products that are inside the fine cut, represented by the inner circles. Only desperate or eccentric customers buy products with performance and size outside the fine cut. Beyond the rough cut, represented by the outer circles, products fail customer specifications entirely, and no customer will buy them. Each fine cut circle has a point where demand is highest. This point is called the ideal spot, and it has the highest concentration of buyers. The high technology segments, high-end, performance, and size, prefer products near the leading edge of their fine cut circles. These customers want the latest technology, sensors that are better performing and or smaller in size. Traditional customers prefer products in the exact center of the circle. Low-end customers want older technology. They don't want sensors that will require them to change their manufacturing system. Therefore, their ideal spot is near the upper left edge of the circle. As time goes by, customers want smaller, more powerful sensors. This causes the segments to move or drift across the map. Ideal spots drift with the segment. The segments drift at different speeds in slightly different directions. Therefore, over the years they separate, overlapping less and less. Research and development must ensure products meet changing customer demands by revising the line to keep up with the segment drift. R&D decisions control 4 product attributes: size, the sensor's weight and girth; performance, the sensor's speed and throughput in measuring and reporting conditions; reliability, how long the sensor lasts before it fails; and age, the number of years the product has been in the market. To reposition an existing product on the R&D screen, enter new coordinates for performance and or size. To keep up with the segment drift, products must be made smaller and their performance higher. As revision projects begin, the product appears twice on the perceptual map, once in black, indicating its present position, and once in magenta, indicating where it will be when the revision concludes. Among other factors, the time the revision takes depends upon the distance the product is moved on the map. The farther the move, the longer the project. As more projects are added, the extra burden puts a strain on R&D, which increases the time needed to complete each project. Customers in each segment expect different levels of reliability. Reliability is expressed as mean time between failure, or MTBF. MTBF predicts the number of hours a product will work before it fails. MTBF is changed on the R&D screen. While the R&D department manages product design, the marketing department controls price, promotion, and place. Each market segment has an expected price range. In general, the higher the technology, the higher the price. The low end expects a lower price range than high end. Within a price range, product appeal follows a classic price-demand curve. Outside the range, appeal falls rapidly. At $1 above or below the range, demand falls by 20%. At $5 above or below the range, appeal drops to 0. Prices are set on the marketing screen. Price delivers the product's contribution to margin. Dropping a product's price will increase demand, but cuts per unit profit. Segment price ranges drop at a rate of 50 cents per year. This puts pressure on the companies to improve their cost structures. Marketing also controls promotion for each product. Promotion creates awareness. It lets customers know the product is out there and available. Over time, however, customers begin to forget your products. Without a promotion budget, a product will lose 33% of its awareness from one year to the next. Promotion budgets are subject to diminishing returns. The first $1.5 million buys approximately 36% additional awareness. An additional $1.5 million buys only 14% more awareness. Higher awareness facilitates sales. For example, if two products have identical attributes and price, but one has 100% awareness and the other 0%, the product with 100% awareness will outsell the other 2 to 1. The fourth P, place, is driven by the marketing department's sales budget. The sales budget builds the sales force and distribution system, which creates accessibility. Without a sales budget, a product will lose 33% of its accessibility from one year to the next. While sales budgets are allocated per product, the accessibility percentage applies to the segment, not the product. Like awareness, 0% accessibility does not imply 0 sales. If two products have identical attributes and price, but one has 100% accessibility and the other 0, the product with 100% accessibility will outsell the other 2 to 1. Product sales budget reaches diminishing returns at about $3 million. If teams have 2 or more products in a segment, each will contribute towards accessibility, but the combined budgets reach diminishing returns at $4.5 million. Awareness can be seen as a before the sale activity, accessibility as during and after the sale. The promo budget persuades customers to look at products. The sales budget is spent on accessibility, that is, salespeople, customer service, and distribution channels. The sales budget facilitates the completion of the sale. Promotion budgets create awareness. Sales budgets, that is, place, create accessibility. Marketing is also responsible for sales forecasts. Accounts payable and receivable finance decisions are entered on the marketing screen. Accounts receivable affects product demand. Allowing customers to take longer to pay improves product appeal, but strains your cash reserves as customers take advantage of the more generous credit terms. Accounts payable has different ramifications. The accounts payable policy affects the production department. Taking longer to pay suppliers frees up cash, but it creates material shortfalls as suppliers slow down delivery. Production, marketing, and R&D expenditures must be coordinated with the finance department. Once R&D, marketing, and production decisions are complete, the finance department will have an accurate idea of the company's fiscal position. The cash position with last year's date is the same as the beginning cash position for the current round. The cash position as of December 31st of the current round shows the projected position at the end of this year. It is taken from the pro forma balance sheet. A red number in the cash position cell indicates a shortfall is expected, and your team will need to turn to the capital markets. Failing to cover shortfalls means the company will run out of cash. If this happens, the money needed to continue operating will be lent automatically from a lender of last resort named Big Al. Big Al will cover your shortfall with an emergency loan which carries an above-market interest rate. The finance department can borrow current debt by entering a number in the borrow debt cell. This is a one-year loan. Current debt interest rates change from year to year. Interest rates increase as debt loads get bigger. The department can also issue stock. As resources permit, the finance department can retire stock and issue a dividend. This is the amount for the entire year per share paid in 4 equal quarterly installments to shareholders. The finance department can also issue long-term debt with 10-year bonds. Bond interest rates are 1.4% higher than the current debt interest rate. However, as current debt interest rates can increase in future years, the department might choose to lock in rates by issuing bonds. The finance department can retire long-term debt. Debt is retired on a first-in, first-out basis. However, the finance department is not required to take special action as bonds come due. As they come due, the bond's face value converts to current debt. If they wish, teams can issue additional long-term debt to cover that amount. Capstone can run up to 8 rounds, 8 years of the company's life. The marketplace changes during that time. Unit demand varies among the 5 segments. The company needs to determine if it will compete in all or selected market segments. To begin making decisions, download capstone.xls from the Downloads